Most people argue about whether it's better to dollar cost average into Bitcoin or invest using a lump sum strategy. You'll hear strong opinions on both sides of the fence, and the problem is they're both right and they both make sense. So which one do you choose? Which one is best for you? I decided to test it myself. I took 9 years of real Bitcoin price data, same money, same asset, and I applied in theory to 2 different ways of investing to see which one actually came out on top. And what the results show is actually more interesting than most people expect. I'm Harvinder Bhogal. I work with people who want to understand Bitcoin clearly and hold it safely as a long-term investment. No hype, no trading, just calm, evidence-based thinking about how this asset behaves over time. And one question I hear again and again is, should you buy Bitcoin gradually or invest all at once? Real quick, for the noobs, dollar cost averaging means investing a fixed amount of money on a regular basis. For example, you might buy $1,000 worth of Bitcoin every month. Sometimes the price will be high, sometimes the price will be low, but you keep on buying on schedule. The price doesn't matter. So instead of trying to time the market, you're spreading your purchases out over time. Lump sum investing means investing all your money at once. For example, instead of buying $1,000 every month, you might invest $12,000 in one go. After that, you simply hold the investment. So rather than spreading the purchases out, you enter the market immediately. So the difference is very simple. Dollar cost averaging spreads your investment out over time. Lump sum investing puts the money into the market all in one go. So let's get into this video and start with a simple experiment. 2 investors, both investing exactly the same amount of money. The first investor uses dollar cost averaging. They invest $1,000 every month. The second investor uses lump sum investing. They invest $12,000 once per year. Over time, both investors put exactly the same amount of money into Bitcoin. Across 9 years, that totals $108,000. So the capital is identical. The only difference is how the capital enters the market. When you run that test using Bitcoin price data from 2016 through to 2024, something fairly clear happens. The lump sum strategy accumulates a lot more Bitcoin. Across the full period, the lump sum investor ends up with about 45.18 Bitcoin to be exact, while the dollar cost averaging strategy accumulates 34.97 Bitcoin, despite investing the same amount of capital. So the lump sum approach finishes significantly ahead. Now, that might sound surprising at first, but mathematically, it actually makes sense. When an asset trends upward over long periods, capital that enters the market earlier simply has more time to grow. That's the key idea. Earlier exposure means more compounding. This doesn't mean lump sum investing is always the better choice, but it does highlight something interesting. When markets trend upwards over time, delaying investment often has a cost, not because someone chose the wrong way, but because the market kept moving while they waited. Bitcoin historically has been a strong upward trending asset over long time horizons. Yeah, you get crashes and you get cycles, but generally it's in an upward trajectory. So money invested earlier has generally benefited more from that growth. But there's another question we need to explore. Is this result purely about the strategy, or could it also depend on when the investor actually started investing? Because Bitcoin markets, as we all know, don't move up in a straight line. They move in cycles. So the first cycle, Bitcoin exploded over 10,000%. But in the next cycle, it was only 3,000%. And then the cycle after that was only 700%. And even more recently, 2025, it was only 100%. So there's not as much explosive growth. So there's an argument to say the earlier you got in, the more chance you had to get exposure to those exponential gains. So to explore that idea further, I ran a second experiment. This time, I focused on the modern Bitcoin era, starting in 2020. Imagine an investor planning to invest $48,000 over 4 years. Again, we tested two different strategies. Dollar cost averaging, $1,000 every month, and then lump sum investing, $12,000 invested once per year, every year for 4 years. But instead of running this test once, I tested it 12 different times. Each test begins in a different month of 2020. One starting in January, another in February, March, all the way through to December. I just wanted to see if it made a difference. Each scenario then runs forward 4 years. So now we're looking at 12 different entry points into the same market to see how much difference the cycle actually makes, or rather, when you invest in the cycle, what difference that makes. It's the same money, same amount of money, but just different strategies. And the pattern that emerges is actually pretty consistent. In every one of these 12 tests, the lump sum strategy still finishes slightly ahead. But something important changes. The actual size of the advantage changes a lot depending on when the investor started. So investors that began early in 2020 saw a larger difference because their capital entered the market before the big moves of that cycle. Investors who began later saw a smaller gap because more of the upside had already happened. And that leads to an important observation. The outcome isn't driven purely by the strategy. It's heavily influenced by cycle timing. When someone actually starts to invest, matters just as much as how much they actually invest. So when you step back and look at Bitcoin's history, these results make even more sense. You can broadly think of Bitcoin as evolving through 3 phases. In the early era, before 2016, this was a period of extreme volatility, like the markets pumped like crazy, but they also crashed like crazy. Bitcoin was still experimental, confidence was low, and price swings were huge. In that environment, spreading purchases out over time often helped investors manage uncertainty. Dollar cost averaging can be very helpful here, especially from a mental point of view. Then came the middle era, roughly from, say, 2016 to 2019. Adoption accelerated, institutional awareness increased, and Bitcoin experienced powerful bull market cycles. During this period, gaining exposure early within each cycle made a big difference. And this is why lump sum investing normally came out ahead. And now we're in what you could call the modern era, from 2020 onwards. Bitcoin is a much larger market. Liquidity has improved. Volatility has slowed down. And because of that, the difference between strategies is naturally becoming smaller and smaller. Both approaches now behave a lot more similarly than they did before. Across all of these tests, one pattern stands out. The worst outcomes didn't come from dollar cost averaging into Bitcoin, and they also didn't come from those who invested lump sums. The worst outcomes came from people who never started, people who waited, people who wanted a clearer signal, people who wanted a better entry price. But markets rarely provide certainty before they move, and by the time something feels safe, the opportunity is probably gone. The price has already moved up higher. So that behavior, the hesitation, is often a lot more costly than choosing the wrong strategy. So the real question isn't which strategy is mathematically best. The real question is this: which strategy helps you invest calmly, consistently, and stay invested over time? If you already have capital available and you can tolerate volatility, then lump sum investing may make more sense. But if you prefer a steadier approach, one that reduces emotional pressure, dollar cost averaging may be a better fit. Both can work. What matters far more, though, than the strategy itself, is participation and patience, because over long periods, Bitcoin has tended to reward the people who simply stayed in the market. So if you like this video, feel free to subscribe. I'll make videos like this every week. And if you want to learn how I invest in Bitcoin, how I teach my private 101 clients to invest in Bitcoin, I've created a separate video. Links in my bio. It takes you through the whole process. I don't hold anything back. There's no opt-in and it's free to watch. So be sure to check that out. Thanks for watching.